Hi friends, in the previous part we dealt with the introduction of business principles to accounting for commerce students, and in this part we have given an illustration that will explain you how journal entries are passed, ledger postings are done, trial balance is taken, and then to the preparation of the final accounts, namely the trading or manufacturing account and profit and loss account, and then the balance sheet. And let's see the explanation here. In the previous part, we discussed about the rule of passing entries in property accounts, personal accounts, and nominal accounts. Nominal accounts are those which are not property accounts and which are not personal accounts. Property accounts rule is debit what property comes in and credit what property goes out. And personal accounts debit the receiver and credit the giver. And in all nominal accounts, the rule is to debit all expenses and losses to the organization and credit all incomes and gains. Now see this illustration on page 1. We have given an illustration to pass journal entries, prepare ledger account, prepare cash book, and sole trader final accounts from this illustration. And let us see the sole trader accounts. Here we discuss about the journal entries to be passed in the books of Dinagaran and Company, the sole trader, and the ledger account postings, cash account postings, and the finalization of accounts of a sole trader business firm. In page 3, we discuss about the journal book of Dinagaran and Company. The first transaction, Dinagaran brought his capital 5 lakh rupees which he has deposited in the bank account. So the bank account is a property account and the bank receives the capital of Dinagaran who has invested in his sole trading business firm. So bank account is debited for 5 lakhs and Dinagaran capital account, Dinagaran is a personal account, Dinagaran is the giver. So Dinagaran account is credited with 5 lakhs. So the first entry on January 1 is bank account debit to Dinagaran and Company capital account. The bottom entry is always a credit entry in the journal book and the top entry with the debit symbol is a debit account entry. In the first line, office furniture debit means that office furniture account is debited, and the bottom line to bank account means bank account is credited. We withdraw on January 4 cash from bank rupees 60,000. So cash account is debited, cash is property account which comes in, and bank is giving the cash, so bank account is credited with 60,000. Labor charges is a nominal account, so it is debited with 12,000. When it is paid by cash, cash account is credited with 12,000. Then when we buy trading goods worth rupees 30,000 for cash, trading goods property comes in, so that account is debited and cash property goes out, so cash account is credited. When goods are sold for cash, cash property comes in, cash account is debited 50,000 on January 10 and sales account is credited because the goods have gone out, property goes out, so sales account is credited with 50,000. On January 15th, office rent is a nominal account which is paid in cash, office rent nominal account expenses debited, and cash account which goes out property that goes out is credited with 15,000. January 18 we pay wages in cash, so wages is a nominal account, it is debited with 3,000 and cash property goes out, so 3,000 cash account is credited. Then we sold goods worth 20,000 to Premchand, 30,000 to Lal Chand and 15,000 to Motilal, and the total sales on January 20 to these parties is 65,000 and goods have been sold, goods goes out, so sales account is credited with 65,000 and Premchand being the personal account, he receives the goods, so his account is debited with 20,000. Lal Chand receives the goods, so his account is debited with 30,000 and Motilal also receives the goods, his account is debited with 15,000. Let's go to page 4. We buy goods and then pay through a check. So goods comes in, so trading goods purchases account is debited and bank account is credited because the money goes out of the bank for 30,000 on January 24. January 25, repairs and maintenance account is a nominal account and it was paid in cash. So repairs and maintenance account is debited and cash account is credited. On January 27, trading goods have been purchased for 57,000 rupees from Dhanalakshmi stores for 25,000, Krishnasamy stores 15,000, Digital Watch Company stores 17,000. The goods have been purchased for 57,000, so goods come into the company and 57,000 purchases account is debited, and Dhanalakshmi stores, Krishnasamy stores, Digital Watch Company stores who supplied these goods to the company and their accounts have been credited because the goods goes out from them and it comes into us. January 28, we have returned defective goods worth rupees 5,000 to Dhanalakshmi stores, 2,000 to Digital Watch Company stores, and the purchase account is credited. So here Dhanalakshmi stores, Digital Watch Company stores receives the defective goods, so their accounts have been respectively debited, and defective goods goes out of the sole trader, so the purchase account has been credited for purchase returns. January 28, we sold goods on credit to Premchand, Lalchand, Motilal, aggregating goods worth rupees 68,000. Trading goods goes out of the company, so sales account is credited with 68,000, and the individual accounts Premchand, Lalchand, Motilal have been debited with 22,000, 33,000 and 13,000 respectively. January 29, Premchand and Lalchand returned defective goods to us aggregating 7,000. Premchand returned defective goods 3,000, Lalchand returned goods 4,000 being defective goods. On January 29, defective goods have been returned by Premchand and Lalchand. So the goods sold by us have been returned to us for 7,000. We receive the goods back, so 7,000 sales account is debited as sales returns, and Premchand account has been credited, Lalchand account has been credited with 3,000 and 4,000 respectively. January 31, we paid Dhanalakshmi stores, Krishnasamy stores, Digital Watch Company stores 5,000, 10,000, 8,000 respectively through a check. So bank account is credited, the money goes out of bank, so 23,000 bank account has been credited, and Dhanalakshmi stores, Krishnasamy stores, Digital Watch Company stores who receive money respectively 5,000, 10,000, 8,000 from us, their accounts have been debited as they receive the cash. Page 5 is a combined cash book with bank column. If we withdraw cash or deposit cash in the bank account, the entries appear on both sides, which is known as contra entry. If we withdraw cash from bank, cash account is debited and bank account is credited. If we deposit money into the bank account is debited and cash account is credited. And these are entries appear on both sides of the cash book with bank column. So when the entries appear on both sides, it is known as the contra entry. In all ledger accounts, the left-hand side is the debit side and the right-hand side is the credit side. In ledger account postings, all entries in the credit side shows the amount credited to the account with the name of the corresponding other account which is debited with its folio number. And all entries in the debit side show the amount debited to the account with the name of the corresponding other account which is credited with its folio number. The entries in the debit side are always prefixed with the word to followed by the account name. It suggests that this account is debited due to that other account which has a corresponding credit entry due to the dual aspect of accounting. The entries in the credit side are always prefixed with the word by followed by the account name. It suggests that this account is credited by that other account which has a corresponding debit entry due to the dual aspect of accounting. When balancing the accounts, ledger accounts, if the credit entries are more than the debits, it shows the net credit balance of that account which is taken to the trial balance. When balancing any account, if the debit entries are more than the credits, it shows the net debit balance of that account which is taken to the trial balance. The trial balance is on page 10 for this illustration. The debit balances in trial balance should tally with its credit balances. Otherwise, it would signify error in ledger postings. Each ledger account is given a folio number sequentially in the order of ledger postings or in the order of priority fixed by you. You may give capital account as folio number 1, sales account as folio number 2, purchase account as folio number 3, bank account as folio number 4, and cash account as folio number 5, and other ledger accounts can be numbered sequentially. The supplier of goods to the organization on credit is called the creditor, and the balances in the creditor's accounts are aggregated and are shown as sundry creditors or as total creditors or as trade payable on the liability side of the balance sheet, as it shows the liability of the organization to pay their debts. The persons, individuals, firms and companies to whom we sold finished goods marketed by the organization on credit are called as sundry debtors or as total debtors or as trade receivable, and these accounts are shown on the asset side as it is the revenue sources of the organization to collect its money from them. If the assets are more than the liabilities in the balance sheet, it shows the profit of the business activity. If the liabilities are more than the assets in the balance sheet, it shows the loss from business operations. Capital account is a liability account as the organization owes money to the owner who invested his funds as capital. Reserves and surplus shows the profit retained in the business for further business operations without distributing that profits to investors. At any time, reserves show the liability of that organization to distribute it to the investors proportionately according to the capital invested in the firm. Other liabilities are split as current liabilities and non-current or long-term liabilities. Accordingly, assets are also split into current assets and non-current assets. Current assets represent all the assets of a company that are expected to be conveniently sold, consumed, used, or exhausted through standard business operations within 1 year. Current assets would include cash, cash equivalents like bank account, accounts receivable, stock, inventory, marketable securities, prepaid liabilities, and other liquid assets. Current assets may also be called current accounts. Current assets are important to business because they can be used to fund day-to-day business operations and to pay for ongoing operating expenses. Non-current assets or long-term assets are those which represent the assets that cannot be conveniently turned into cash within the space of a year ahead. They generally include land and buildings, facilities, plant and equipment, copyrights, and other illiquid investments. Current liabilities are a company's short-term financial obligations that are due within one financial year or within a normal operating cycle. Current liabilities are typically settled using current assets, which are assets that are used up within 1 year. Examples of current liabilities include accounts payable, short-term debt, dividends payable, and notes payable, as well as income tax payable and provisions made for fees payable to professionals like chartered accountants, company secretary, and cost accountants. Current liabilities include short-term and long-term borrowings. Long-term borrowings are term loans taken which has a period of repayment more than 1 year. Long-term borrowings are shown as non-current liabilities. Short-term borrowings, overdraft facility from bankers are shown as current liabilities. Trade advances made for supply of goods and services to the organization are shown as current liabilities. Similarly, trade advances received for supply of goods and services by the organization are shown as current assets.